Hello everyone, welcome back to ForPips. In today's lesson, we're going to discuss how does the Forex market actually work. It is the world's largest financial market where millions and billions of dollars are traded every second. So, who runs this market? Where does all the money come from? Who provides the liquidity? And most importantly, if there is no single exchange like the stock market, then how are trades and orders executed? Once you understand the answers to these questions, you will have cleared half of your Forex knowledge. What is the foundation of the Forex market? The Forex market is mainly built on four key pillars: decentralized market, OTC, over-the-counter, market liquidity, market participants. Let's understand each one step by step. What is a decentralized market? First, let's understand what decentralized means. A decentralized market is a market that does not have a single owner or one central exchange. For example, if you look at the Indian stock market, it has exchanges like NSE and BSE. Stocks are bought and sold through these exchanges. But the Forex market is completely different. There is no single central office, there is no single exchange, and no single company controls the entire market. That is why the Forex market is called a decentralized market. Instead, it operates through a global network of banks, financial institutions, brokers, and traders. They are all connected to each other. This worldwide network keeps the Forex market running 24 hours a day. What is an OTC market? Now let's understand a new term. OTC stands for over-the-counter market. It simply means direct trading. In an OTC market, transactions between a buyer and a seller do not take place through a central exchange. Instead, they are carried out through a network of banks, financial institutions, and brokers. For example, if one bank wants to buy US dollars and another bank wants to sell US dollars, they can trade directly with each other. There is no central exchange, such as NSE or BSE, involved in the transaction. This system of direct trading through a network is called the OTC market. That is why the Forex market is considered the largest OTC market in the world. Now let's talk about the most important concept. Friends, do you know how big the Forex market really is? You may not even imagine its size. Every day, more than 7.5 trillion US dollars, USD, are traded in the Forex market. No other financial market in the world has such a huge daily trading volume. That is why the Forex market is known as the largest financial market in the world. Now you might be wondering, if so much money is bought and sold every day, where does all this money come from? This brings us to a new term, liquidity. What is liquidity? In simple words, liquidity is the ability to buy or sell an asset quickly without causing a significant change in its price. For example, imagine you have a mobile phone. If it takes 6 months to sell it, the phone has low liquidity. But if you find a buyer immediately and receive your money right away, that means the asset has high liquidity. The same principle applies to the Forex market. There are millions of buyers and sellers in the market at all times. That is why you can enter or exit a trade whenever you want. This is why the Forex market is called the most liquid financial market in the world. Thanks for watching. Stay tuned for the next part, and don't forget to subscribe to our YouTube channel.